Welcome to Investories, a podcast about real stories, real estate, and taking real action. Join hosts John Hooper and Kyle Robertson as they talk investing, mindset, and taking that first step. We all have a story. What's yours? The Investories Podcast.
4, 3, 2, 1. Booyah.
Booyah!
Booyah. Hey, Kyle, how are you?
Great, John.
Wait, I didn't do the Welcome to Investories podcast.
Oh, let's back up. Go ahead.
Welcome to the Investories podcast. I'm John Hooper, your host, and with me is...
Kyle Robertson.
Kyle. Yeah, Kyle, you were out last week.
I was, yeah, we were, out.
Where were
we
you?
went down to Mexico. Yeah, we went to Mexico, took the kids out of the country for their very first time. And that was a blast. We took
You're
a
on your
cruise.
yacht, right?
We were, yeah, my yacht. Yeah, I told the kids, because we got to see a lot of yachts on this cruise, I told them mine's on order, be here in about 30 years. But there's some super fancy, nice stuff at some of these ports. It was cool to watch.
Yeah, that's where. Who knows where that money comes from? Let's not speculate.
Right. We thought they were all, Russian oligarchs over here. That's where they're hiding out, is on the coast of Mexico.
Their boats somewhere, right?
Yeah, right.
So today on the pod, we've got Kaaren Hall, who is the founder of uDirectIRA. It's a bit of a different episode today. We're going to talk all about retirement. Who doesn't want to retire? Kyle's already retired, so that's good.
Yeah, right.
But really about the self-directed IRA product, which is all about controlling, not just throwing your money in the stock market with the 401k kind of product, but being able to invest in all sorts of things from real estate to crypto. So I have one of those accounts, and it's super interesting and kind of gets you thinking and challenges you to kind of make your money work for you rather than just kind of sat on it and hoping the market does its thing, which is kind of cool.
Yeah, super cool. And so I am not a retirement account guy. But like probably most people listening to this, I still fall into that category because I have one from a W-2 that I previously used to work at. And I am a real estate investor by trade now, but I still have that account. I never cashed it out. And so although I wouldn't go out and open my own, I learned a lot of things today about Roth IRAs or self-directed IRAs that could be super beneficial for people like me and for people, other listeners who are like, I don't want to go open a retire. I'm 40 years old, but hey, if you've had this account sitting by, this would be a really good option for a conversion. Pay the taxes now so that all the money after that, whenever you pull out your Roth, say in 30, 40 years, you don't have taxes on it anymore, which could be super beneficial. So lots of really good stuff that Kaaren told us about today.
Yeah, a lot of techniques and tactics that you can kind of use from early on and figuring out how to get your money working for you, which is always a good thing. Before we jump into the episode, I did want to say, hey, give us a 5-star review on wherever you're listening to this. And if you're watching it on YouTube, poor you, seeing our faces. But if you are, please do like, subscribe, share, whatever. It all helps us. And why not connect with us on Instagram, Investories Pod. And if you have any questions or suggested guests, or you're a guest that wants to come on, reach out to us and come say hi. And we'll get you on and hang out and hopefully have some fun, Kyle. Who knows?
Always have some fun. Yeah.
Excellent. There we go. Well, without further ado, here's Kaaren. Welcome to Investories, Kaaren Hall, right? I said your name right.
Yes, you did.
Because you prepped me before. We go through this every week, right, Kyle?
Sounds better in British. I like it. Yeah.
There you go. Yeah, maybe I can. I feel like I can coast by on most people's names. Usually it's the second name, but yeah, it's a constant source of Kyle's amusement, right? Is how I pronounce people's names.
I'm almost starting, expecting you to start telling people, no, I'm doing it right. You're pronouncing it wrong,
Yeah.
Kaaren.
Let me tell you how to pronounce
I'll
that.
tell you how to pronounce your name.
Kaaren, welcome to the pod. Great to have you on. You're based in Irvine, right?
Right. Irvine, California, Orange County.
Sunny Irvine.
Yes, I'm not an Orange County housewife, though.
Quite far from it, right? Yeah, and Kaaren owns uDirectIRA. IRA, I've now learned, is the correct way to say that, even though I have my own self-directed IRA. Can you give us the kind of brief of what that is, what your company does, what a self-directed IRA is?
I sure will. I mean, first off, I think we can go back to, go back a few years and just think about retirement in general. So before the Industrial Revolution, how did people retire? You just had a farm or you did something, you had a craft or something, and you just did this way. But when Industrial Revolution, now people are in condos and housing and everything changed, and our whole lives changed. And so you had to start saving. And then really the way that we were saving wasn't sufficient because Social Security came around and the government realized, hey, this isn't good enough. A great majority of our national budget goes toward entitlements like Social Security. And so in the government's best interest, it's like we can't, or in the people's best interest, I hope, is that we can't really, carry everyone into retirement, especially now with the silver tsunami we've got going on. So we need to create a vehicle. So it was in 1975, this act called the ERISA Act, the Employment Retirement Income Security Act, was passed. Gerald Ford signed it into effect. It tells you how old it was, right? And that created IRAs. So IRAs, individual retirement arrangements, so it's an acronym, have been around since 1975. And ever since that day, you've been able to invest really in anything, except life insurance contracts and collectibles. But what happened is that Wall Street kind of got a hold of it and said, okay, invest in stocks, bonds, and mutual funds using this vehicle. And a lot of people did not realize that you could invest in alternative assets. And a lot of people who sell you stocks, bonds, and mutual funds cannot recommend that you invest in alternative assets because of their license, there's 7 or 6 or 63 licenses. Don't let them do it. So the alternative asset space for IRAs is the self-directed space. And this industry has been around, I don't know, well, really just a little bit after 1975. And there are some of the older companies that are around that started in the early days. And uDirect started 15 years ago about, here in Irvine. So a self-directed IRA is an IRA that lets you invest outside of Wall Street into assets like real estate, which includes, multifamily and includes self-storage, single-family homes, duplexes, everything real estate related, while land, and even lets you be the bank and take your retirement and lend it to people so they can buy real estate. And there are a lot of other things too, but in a nutshell, that's what a self-directed IRA is. An IRA is an IRA, but it's the kind that lets you invest in alternative assets.
Outstanding. Thank you for that wonderful definition. I mean, that clears up a lot of things. I do want to take a step back just for a second because I know that our listeners are going to want to get to know you a little bit. And do you invest as far as real estate or stocks or whatever? What exactly do you like to invest in? And do you utilize what you sell with the uDirect IRA?
I do. And in fact, I was just having this conversation before our call here, and that it's talking about like retirement. We can start there, and I'll talk about investing too. But when you think about retirement, like how are you going to get there, right? And so you really have to invest, and you have to build up these layers. I guess you could call it a capital stack for your future. And the layers consist of a lot of different things, a lot of different investing. So you've got Social Security for your retirement. That's a first layer, I suppose. Maybe your personal savings on top of that. And maybe some whole life insurance with cash value, maybe some annuities on top of that. And then you've got your retirement, your 401k, 403b, 457, your IRA, that retirement savings that's got tax protection. And then on top of that is your alternative assets, like if you've got rental properties, you've invested in private equity, you've invested in these different asset classes. So one of the things you want to do to be able to retire is to think about, hey, how am I going to stack this? How am I going to have multiple streams of income when I'm not working anymore? And self-directed IRAs are the answer to that. So there's that much. But the other question, what do I invest in? My background, after I was a radio announcer for 17 years, I made the logical transition into real estate. I worked as a property manager, got a real estate license, and then went into mortgage loan servicing for a number of years. And I had kids and I was raising kids, and then even loan origination for a number of years as well, until the Great Recession. And then during at that time, so you weren't going to be making any mortgages, in 2007, right? And so I wasn't doing that. But I have to find something else, some other vehicle for my skills. And I got hired by a self-directed IRA. And I worked for them for a couple of years and learned it. And then in 2009, I went out on my own and started uDirect IRA services. So I'm kind of still bypassing the investing question. But if you want me to, I'll still hit that if you want.
Yeah, if you don't mind just sharing what types of investments it is that you like to invest in. Are you still investing in real estate, or are you primarily just in IRAs?
Well, I understand an IRA isn't an investment. An IRA is a bucket that holds assets. So it's like, what do you put in the bucket? But yeah, absolutely. Real estate all the way. I mean, in various forms. I'll lend money. Obviously, being the CEO of a self-directed IRA company, I know a lot of people raising capital, right? So, and some of them are my friends. I know who some good, good and bad players are. So I'll pick out a few of them, and I've made loans to people who are my favorite thing is the forced equity of tearing down a property, a single family, and turning it into a fourplex. And you've got forced equity even in a rising market. And so I've made some loans to those kinds of assets. I've invested in private equity. You probably have a dozen of these, alternative real estate investments around either debt or equity.
In terms of, so that's super interesting, and what you've touched upon, and this is probably my question, and I may preempt it with my answer that I'm going to give, which is the one thing I found was I'd finished a job and I had my 401k from that job, and I wasn't sure what to do with the money, and all I could see was stocks and micro movements up and then crashes down and then up and down. I was like, I don't really know what I'm doing. I don't really know if this is good and if it's effectively working. And that's why I took my previous 401k into a self-directed IRA for the view of, I invest in ground up builds in the UK and get a pretty good return on it. Was that kind of where your interest peaked, was having that control? Or kind of what was the driver into that kind of space?
Well, the driver was it was just where life was leading me into real estate as a way, because like so many other people, you can really build wealth in real estate. I think that's one of the reasons. But also too, I like hard assets. I like assets that you can touch and feel, and something where you've got more control over it. And so I think real estate's the best thing. And also it's such a win-win situation. When you take your retirement and you invest, say, in a property and rehab it, so what you've done is improved a property, which then improves a neighborhood, and it gives somebody a nice place to live. And then it throws rent, hopefully, like in a scenario, could throw rent back to your IRA. So everyone's winning here. Better neighborhood, nice place for people to live, rent coming back in your IRA, and no one loses in that situation. Plus, all the people you hired to do the renovation, they had a job. So a self-directed IRA is a very powerful vehicle in the sense that it does good things for so many different layers of interests.
And one thing I haven't heard you say so far is that word Roth. Are we talking about Roth self-directed IRAs, or is that a completely different vehicle? And do you guys also participate in those?
Yeah, well, so the IRA, the individual retirement arrangements, it's so many different things. It's a traditional IRA, a Roth IRA, SEP, that's an acronym for Simplified Employee Pension for someone who's self-employed. A simple, and if the government calls it simple, it's not, right? It's a savings incentive match plan for employees. It's not as popular because it doesn't have as much benefit as the SEP, but it still exists. And then there's also a solo 401k for entrepreneurs who don't have any full-time employees in any of the companies they own. So these are some of the different accounts that can be self-directed. And absolutely Roth, yes, with tax-free earnings. Who doesn't want tax-free earnings?
Yeah, and that was kind of what I was leading to, was because you fund a Roth with post-tax. Is that right? Am I saying that right? Post-tax?
Yeah, well, you've already been taxed on it.
After tax proceeds. Yeah,
exactly.
So you're funding Roths with after-tax proceeds. This is something I've had a lot of conversations with. So what is more beneficial? Do you let this thing grow for before you pay taxes for such a long period of time and then you get taxed at the end, or do you just pay the taxes now and let this thing grow exponentially, compounding interest and all that good stuff? Do you have any thoughts on that? Which direction is best for somebody?
I do. I think that when you start saving your retirement, it ends up being pre-tax a lot of the time, because you probably start retirement savings in a traditional IRA. You can start in a Roth too. That would be great. But you may start at your business, and your business probably has a pre-tax account like a 401k, 403b. And in recent years, the Roth component has been added to those employer plans. But that's usually where you start off. So people will start off with pre-tax retirement savings. And then the question is, do I want to convert to Roth? And so if you're going to change pre-tax and after-tax, you get taxed on this. You convert $100,000 from your pre-tax account to Roth, where you're going to pay income tax on that $100,000. Converting is something people like to do when they've had a loss that year, and they can mitigate the tax situation, right?
I was going to touch on that, because I've got, from a past life, which was W-2 time, I have a handful of retirement accounts that I haven't contributed to in years. There's really no better time than right now. And I don't know, maybe it'll continue to go down the market, but I've been sitting here talking to people. Should I just do my conversion now? Because I've got the lowest balance I've had in 2 years. So what better time to pull that massive trigger and pay these huge taxes on my balances by converting over to a Roth? And is that something that you also tell your clients to do?
Well, I don't, because I don't give tax advice, but I would talk to your tax person who knows your whole, scenario and all of your entities that you have and what your goals are and so forth. It's really a tax question. And it's also part of your tax plan. I mean, if you're an investor, it's good to have a plan. It's great to have advisors, and you've got to have a plan. So plug the Roth conversion into your plan and see how that comes out for you.
In terms of that process of setting up a self-directed IRA, and I said IRA.
It's
I'm
okay.
in trouble, right, Kaaren?
No, you're not in trouble. You're only in trouble if you call me Kaaren.
Oh, yeah. So in terms of setting that up, Kyle's disappeared, so I'm going to get in trouble with Kyle. What does that look like from because I think what would hold a lot of people back, and I'm not sure if Kyle's more in the converting to Roth, but in terms of setting up an account and setting up a self-directed IRA, what does that process look like?
It's super easy. The whole process is really a 3-step process. To open an account, which is to complete a form and provide us your ID. We have a $50 setup. Pretty simple, really, really simple to open an account. 24 hours, your account's open. You have access to our business platform, and a nice platform where you can see things, what's going on, what's coming in, what's going out. That's easy. The second step is to fund it. So either you're going to roll over a previous employer plan. That's called a rollover. It's a different process. Or you may transfer an IRA you have already to us. And understand that if you're going from custodian to custodian in a rollover, custodian to custodian in a transfer, it's not taxable to you. It would only be taxable if it came to you, went in your account first, then you'd have 60 days to get it back into a retirement account. So that's not taxable. But the other way to fund an account is to contribute. And that's based upon your age and your account type and your income, actually, because you could make too much to contribute to a Roth. And that's why they came up with the backdoor Roth, so you could convert and get in through the back door.
We're going to definitely dive into that.
Yeah, so you open it, you fund it, and then you invest. What do you want to invest in? We look at the documentation. You give us we call it the supporting documentation. It's the agreement, the contract. I make sure it's vested in the name of the IRA and so forth. Get it all queued up so when the money hits, we can fund it, and now your IRA is self-directed. And then all the proceeds for that asset go back to the IRA that owns the asset, goes back to the self-directed IRA, not to your personal checking account ever, not to a different IRA ever. And then if that asset ever has any expenses, like what we're seeing now with private equity is capital calls, because the interest rates have gone up unexpectedly. And so capital is needed. So if you need a capital call, you need to leave a reserve in your IRA, a reserve of idle cash, super important, so that you've got money to cover expenses like that. And those have to be paid for by the IRA.
So I really want to dig into the real estate piece of using your IRA to invest. Before we do that, what can't you invest in an IRA? And I know you can't invest in luxury watches or a car, for instance.
Right. Oh, well, and it's a pity, right? Because that would be great. But, or you can't invest in a fine wine collection either, because those turn into bottle collections, So the IRS said you can invest in life insurance contracts and collectibles, just two things that you can't invest in, but there's wisdom in that. It's in those two things. It covers a lot of ground.
You mentioned a little bit ago that there is a maximum amount based on age, and also if you're a certain age, you're not even eligible to invest in an IRA any longer. Did you say that? Did I misunderstood when you said that?
Well, that used to be true, but At the end of 2022, we had something passed called the Secure Act 2.0, and it eliminated that. Or was it Secure 2.1? That was eliminated. You can still contribute as long as you have active income.
Gotcha. Okay. And what is I know there's a max on annual contributions, and I know it's different per age, but do you have those statistics? Because I don't.
Sure. It's also on our website. If you want to go to the letter U, uDirectIRA.com, it's there. But say you have a traditional IRA or a Roth and you're under 50, you can contribute $6,500 a year. Now, that's if you have a traditional and Roth, it's combined. It's all of your Roths and all of your traditional IRAs combined. You can only put $6,500 a year in there. Now, if you're over 50 or over, you get what's called a catch-up contribution. You can catch up as you get closer, and that is presently $1,000, so $7,500. And we may see that change in the future, but that's how it stands today.
That's really interesting. And is that in addition to, say, someone who has a W-2 with a 401k? Is that $6,500 on top of the contributions they can make in that program?
You can have a 401k where you work and an IRA. You can do both. 401ks are a different kind of account, and they have different contribution limits. So do SEPs. A 401k from your company, it's, I believe, $21,500 is the cap if you're under 50. And then if you have a catch-up contribution of $6,000, so you can tack that on there. Same thing this year in 2023, contribution limits were raised for solo 401ks and SEP IRAs. And it's the lesser of 25% of your income or $66,000. So say you're self-employed and you have a SEP IRA, simplified employee pension, and you make whatever, say $300,000, you can contribute up to $66,000 to your SEP IRA and take a tax deduction. So each one is different. And because when we get down to it, there are complexities. That's why we offer a 20-minute free consultation. Like, tell us about your situation. What are you looking to do? And talk about everybody's individual situation, because we can really get in the weeds with details.
I think a lot of people like to try to figure out these special ways to take advantage of some of these investment vehicles. Like the most common one you already mentioned is the backdoor Roth. I've also heard of the mega backdoor Roth, which is another one that just continues.
Sounds interesting.
Well, Peter Thiel, I'm not sure. He famously became a billionaire off of Roth IRAs. It's really kind of an interesting story. If the listeners have an opportunity to check it out, then Google Peter Thiel and his Roth IRA escapades. Are there other ways? Let's figure out other ways that we can screw what the government tells us we can't do. So you get these annual contributions of a max of so-and-so, but what if we become business owners? Can we then make ourselves employees and open another Roth IRA in our own names, or is this attached solely to our Social Security numbers? How do they monitor these types of things?
Wow, that's so an interesting way to ask that question. And it's an individual retirement arrangement, so it's really tied to an individual. But for a traditional and a Roth, with a SEP, it's tied to a sponsoring company, which can be a sole, and same thing with the solo K, it could be a sole proprietor, LLC, C Corp, S Corp, what have you. So there are accounts for employers and accounts for individuals. You can double up and have different, multiple accounts. There's actually no limit to how many accounts you can have. But can you really screw with the IRS? I wouldn't do it. And,
Well,
that's
why
not
not?
really
Sage-like advice. Sage-like advice.
well, I mean, that's not what we're here to talk about. And if you ask Wesley Snipes, do you want to screw with the IRS?
Right.
The answer is no.
The world
Yes
is
or
full
no?
of stories of people who tried and failed miserably.
Well, and Peter, right? So to that point, after it was disclosed that he had invested, I think was it PayPal or something at the early stages
Yeah.
or something like this, and he had billions in his Roth IRA, tax-free money, crazy. How did he do this? That created a giant and expensive, a deep dive by the government into how did he do it,
Nice.
and how many people who have these mega IRAs cheated. And you can cheat in a Roth if you falsify the value, and you don't want to do that because then you'll get nabbed, because Roth fraud is really on the radar of the Department of Treasury and the IRS. So, but what they found out, that's a fun thing, is that they worked so hard and spent so much money to research these 400 people who had mega IRAs, like 400 people out of the entire United States of America. That's all it was. It was a lot for nothing. And they don't think they found any fraud at all. They pretty much all did it legitimately by the rules, by the book.
That's what gets me. It's like, leave the people alone. They figured out a good idea. There's only 400 of them. It's not like they're going to break I mean, they're investing their own stinking money. Give me a break, you know?
Yeah, and they're following the rules. So they followed the rules that were created for us. And yeah, you're right. That's pretty much how it went. So it wasn't anybody breaking the rules to get there.
So speaking of that, one thing I found interesting, and as I said, my journey was I saw stocks and not doing anything and not knowing anything about them. I was like, well, I want to invest in something I kind of understand. What's the mindset of kind of your clients and kind of how you help coach them in terms of what they're investing in or what they're open to invest in? Because there is that self-ownership piece. The self-directed piece is quite something quite to get your head round, I guess, is the easiest way to say it.
Well, I think that the audiences I speak to are usually investor audiences, like maybe on Bigger Pockets or, various venues like this, and where I'm already speaking to maybe real estate investors or private equity investors or precious metals investors. And they're people who've already educated themselves on a certain alternative asset class. And then this is self-directed IRAs, solo Ks, everything is a way to raise capital if you're raising capital for your deals. That's one thing that IRAs do. And the other thing is to build your own retirement. So we want to help people that have some level of education. You don't want to experiment with your retirement dollars because they're not easily replaced, right? And so you want to make sure you know what you're doing, or that you're working with an asset sponsor who is, you've vetted them and they're, they know what they're doing, they're smart, they're making a return. You talk to their current investors and see, hey, how's it going for you? And you investigate them, do your due diligence.
And to that point, one thing I found and kind of doing the strategy side of things was it doesn't need to be a get rich quick scheme. So I don't mind a bit of crypto, but I would never do that with my self-directed IRA because I want that, what I'd call a wave. I want it to push forward and grow. And I don't want to have these huge drop-offs and just roll the dice on it. It's kind of, it's for 20 years time. I don't need to worry about whether it's like going 50% today. So that's kind of a good rule of thumb I found throughout kind of what I was looking at to invest.
And I agree, because retirement, are you ready to retire? No. I mean, look how far retirement is for you in the future. And so you've got a horizon. And so of course it's a get rich slow kind of scheme, right? But the great thing about self-directed IRAs is you invest and you get proceeds back. Those proceeds are not taxed. And so the proceeds, and including, like your capital and the gain, can go out into your next deal. And so you keep, snowballing this, and it gets bigger and bigger and bigger, you hope, because you don't want to face any losses. But if you do, that's going to hurt. But you keep building and building and building without being taxed. And maybe you're taxed at the end in a typical kind of situation, or in a Roth situation, it comes out tax-free. But because this is tax deferred while you've got the money in this tax-protected little bubble here, you can really compound, and that's the power of self-directed IRAs, self-directed investing.
So some of the, I'll just full disclosure, I have no Roths, I have no self-directed IRAs, I don't have any of that stuff. So some of my questions are probably going to sound pretty entry level. So as far as how this works, let's say I'm an employee of somewhere who has a Roth IRA of $200,000, and I find a real estate deal a self-directed IRA that I really want to invest in, and it's going to take all $200,000 that I have in there and then some. Do I still have the ability to invest in that deal if I can't swing it with just the funds that are inside my IRA?
Yeah, it's a great question. Yeah, there are two ways to do that. One is to partner with someone, because you don't want to use every dime of your IRA to invest in an asset that you know will have expenses, because you need a cushion, right? So I wouldn't just throw it all in there, because you're going to hurt yourself, and then you're going to end up having to sell it because you can't keep up with the expenses. So the one way to do that is to partner with somebody, have a more positive experience that way. Or, and I'm glad you asked because it lets me get into this topic, your IRA can actually borrow money. So like I mentioned, part of my background was mortgage lending. So when I found out that a bank would lend money to an IRA account, I was super surprised about that, So it's called a non-recourse loan. It's a commercial loan, and it really, they underwrite it based upon the location of the property and its condition, but mostly the cash flow. So they want to see that you have a rental agreement in place so that they know that property is cash flow. So you could take out a non-recourse loan, but if you do, there's a catch, and that is a special tax that could be associated to your IRA due to leverage. So say you don't have enough to take this deal down just with your IRA money, even though you've got 200 grand in there. So maybe it's like a $300,000 property. So you borrow 150 or something, you come in with 150, and then you've got a 50% loan to value. So now here comes a rent check. Well, 50% of that rent check your IRA earned because of borrowed money, because of leverage. And that 50% due to leverage is subject to this tax. So again, you want to begin with the end in mind. You want to talk to us before you do this so we can help you plan this out. You can talk to your advisors about what that tax is going to look like. Because even when you do have to pay UDFI tax, you may have write-offs and end up paying no tax at all. You just have to file a Form 990T. So you really want to discuss this with your tax advisor before you go forward with having your IRA borrow money. But you can do it. It's another way to, fulfill that goal of the $200,000 Roth that wants to buy a house.
And is there a rule of thumb in terms of that contingency for expenses?
10%, I think, is moderate. It's not conservative. It's like bare minimum.
Yeah, I was going to say what happens if there isn't money to cover it?
Right. Well, a few things. Like one, you can contribute and add, make up for the shortfall. You could move money from another retirement account. Maybe you've got another retirement account, like in the stock market, you've got market correlated assets, liquidate those and transfer them over to your self-directed IRA to make up the difference. If it's a property, you could take on a lender. You could take on a loan maybe from a friend or something and have them loan your IRA the money, maybe in exchange for a piece of the action, like it's some equity. But if you just can't cover the expenses with your IRA reserves, then you really need to sell the asset because you've gotten in over your head.
Interesting. Yeah, that's kind of one of the things that fills me with terror is like not being too razor thin with the money and going down that route, and hence why I haven't gone down that route. In terms of what you can do with a property, you can't live in it. I know that. Is there limitations of the kind of function of that property when you go through the self-directed IRA route?
And by the way, I just have to first say that we have no intent of striking terror in anyone's heart. That's why we help people avoid these things, And so we have lots of thousands of happy account holders. But your question again is what now?
Well, in terms of what you can do with the property within that vehicle, I guess is probably the easiest way to.
Sure, you can't live in it. You're not even supposed to stay in there one single day. I mean, technically, it's not like they're police yet monitoring that. And yeah, just having fun. And so you have no personal use. And with your IRA assets, it's arm's length. So you don't have personal benefit, present benefit, indirect benefit. It's all for later. IRAs are all for saving for later. You also can't offer services to the plan. So say you have this property and it's a rental. What you can do is screen tenants, pick up and collect that rent check. You can hire third-party vendors, but you will not collect a fee for being the property manager. That would be prohibited. You would be personally benefiting from your IRA. So you want to steer clear of that. But just with any IRA asset, you just want to stay arm's length from it. And then that's a good rule of thumb. And it gets, more complicated from there if it does, just take it from there.
That's really interesting. Is there anything of sort of trends you've seen that you would or wouldn't invest in through self-directed route?
Well, I'm not an investment advisor, but I did read one time, buy low, sell high. Call me a genius, but I read that.
I like it.
You came up with that yourself, didn't you?
I did.
Come on.
Yeah, thanks.
Never
That's
heard of it. Yeah.
You're
It's going to be
welcome.
big.
Yeah. But after the recession, we had these properties. You could buy properties on tape. People were buying low. Oh my gosh. And then we saw recently, the last, I'd say year even, people selling at the high. We've had a real peak in real estate prices. And so they bought low and they sold high. So a lot of people really did it right in their IRA, taking advantage of maybe a once in a lifetime opportunity. When real estate values were low, I don't think we're going to see that again. I just don't think that. But people bought low and sold high. So when you find a situation like that, or you find a distress issue where someone's willing to discount an asset really below its value for urgency, because a lot of times people haven't, why would you sell a perfectly good house like this? And then they tell you they're getting divorced, or they have to move, or they have some urgency. And you might find a real deal and be able to get a below market price on an asset like this. I was quoting Pete Fortunato. Give him credit.
And if you hit those time periods, that's amazing. That's the perfect route for this. In terms of, so we talked briefly about the financing piece, the non-recourse loan piece. Where do people find those kind of loan products?
We have a list that we are happy to share. It's not that we necessarily endorse them, but it's just as a convenience. And we'll share that with anybody that emails us, info@uDirectIRA.com. We'll share that list with you. And then you can check them out, speak to them, tell them what you're looking to do, find out their underwriting guidelines, and see if that works for you.
Yeah, one of the things I found really interesting is that educational piece of figuring out how money works. So figuring out how, if I wanted to go down that route, buy a property and go through non-recourse loans, is it quite the right time for me? Probably not, actually. And kind of thinking about how that works. But then the velocity of the returns of money. So is my money working hard enough? Is it sat somewhere and not kind of doing anything? If I'm getting a good return, but I can't buy anything else, what do I do with that money? So it becomes a bit of a game, I guess.
It does, and I think that's why these investment clubs are so popular, because you can meet, in person now and talk to other people. What are they doing? You meet someone, then they're succeeding. How did they do it? And if they did it, you could do it. And so you learn from the way others are doing it. And there are just so many different techniques.
So one of the things you did touch upon was the partnership piece. Is that partnership with another IRA, or is it any kind of partnership, or what does that look like?
It could be, yeah. It could be another IRA. It could be someone else's private cash. Now, we didn't cover disallowed people. You're not allowed to invest with your ascendants and descendants, parents, grandparents, yourself, your spouse, children and grandchildren. But an exception, you can actually partner with a disallowed person. So you could partner with, say, for example, your spouse, both of your IRAs in a deal, as long as you closed and recorded concurrently. And that's an exception. So you can partner even with disallowed people as long as you close concurrently.
And so that has to be through a IRA vehicle. It can't be through kind of private investments or.
No, it sure can. No, yeah, it doesn't. But that's just like how you would use an IRA. The IRA requirement is concurrent. But of course, with your private money, there's no limit in this regard. But yeah. So you could definitely partner and have maybe 2 or 3 people in on a deal. But when you're doing that, especially with real estate, that's probably when you want to have a property manager involved, because otherwise the renter would have to make, say, if you had 4 partners in a deal, 4 checks every time they paid their rent. Better to write 1 check to the property manager and then let them sort it.
Yeah, I'm not sure how that would go down with some tenants. Can you cut your rent weekly? Maybe, I don't know.
Yeah, no, I mean, it's hard enough to get them to write 1 check, isn't it? So
making sure that comes in. In terms of the kind of the changes or the future of specifically self-directed IRAs, but that kind of space, is there kind of legislative change coming in that we're going to kind of, this really going to change things up, or?
not too dramatically. I think we've had Secure Act 1.0 come through in 2019. It raised the RMD age required minimum distribution. It had previously been when you turned 70 and a half, the year after you turned 70 and a half, you had to start taking money out of your pre-tax accounts. And there was a formula, you look on a grid and you find the factor and multiply the factor times the money that you have in your retirement account. You have to remove that. Secure Act 1.0 raised that age from 70 and a half to 72. And then at the end of 2022, like the very last day of the year, Secure Act 2.0 passed. And as a result, the age is now 73. So now the RMD, required minimum distribution age, is 73. Secure Act 2.0 said that in the year 2033, in 10 years, that age will go to 75, just sort of reflecting how we are living.
I have a question.
Yes.
What is the purpose of a maximum, whatever the term was that you just said? Why make anybody pull money out at all?
Well, tax.
But okay, so what about for Roth? Does that have the same issue since these are all pre-taxed, those types of investments?
Really good point. So the Roth, well, I mean, the reason that they want the money is because the government wants to tax your dollars. But now I think it's more advantageous for the government to have us take care of our own retirement instead of relying, on the collective here. And so what they've actually done also with Secure Act 2.0 is come up with 2 new types of accounts that are effective this year, but we don't have any guidance on them yet. It's a Roth SEP and a Roth Simple. So I'll explain. What that means is that today or before the 2.0 passed, if you were going to contribute to a SEP IRA, it would be pre-tax dollars. You would make the contribution and get a tax break. But now, after they come out with the guidance, you can contribute, you'll be able to contribute, say a SEP IRA after you paid your income tax on it, and that can grow tax-free for life. So that's the law. It passed, but it's not into effect until the Department of Treasury gives us guidance and prototypes and things like that. We don't have that yet.
Gotcha. Since we're on the subject of old people, so when you become an old person and you die, what's the survivorship look like with these types of these vehicles? Typically, I would assume you want to put into family trust because you can put most of your investments in there. I don't know if that's the case across the board, but if this person hits the age of 73 and now they're required to take these disbursements and then they die, so they have a pretty large balance, does that person who inherits have to continue taking those distributions, or is this now a new investment vehicle where they can do whatever they want with it?
Wow, that's excellent. Yeah, yes, the IRAs are like mini trusts. So when you when you pass away, the IRA is automatically going to go to your beneficiaries. So the IRA will immediately pass on to your beneficiaries. And right when they inherit the IRA, they are going to also inherit the need to take the RMDs based on the lifetime of the deceased. But that's changed. It could also be based on your lifetime. And really, the IRS is now looking for it to happen within a 5-year time window. So you can take a total distribution or you could leave it in there, but they do want you to deplete that retirement account, and so the government collects tax on those dollars. But inherited IRAs are great because, again, whether it's in a trust or not, that's something you can discuss with your trust attorney and your CPA. It's not going to go into probate because an IRA is like a mini trust, as long as you've named your beneficiaries, it will go directly to the beneficiaries without passing through probate.
There you go. So Kyle, your kids are gonna have a lifetime of partying for 5 years, and then
No,
and then that's it. They got to get rid of it all.
no.
I'm just kidding.
We are
Of
those
course
we
not.
are those people who are going to sell everything before we die and give it all away and wave at our kids as we, as we're on our way out.
This is taking a glib turn.
Was that dark? That sounded kind of dark,
Yeah.
but that's not the way I meant it. But
Well, I mean, what do you
Ways
learn if you don't earn it yourself and you don't appreciate it?
there you go. Thank you very
There you
much.
go.
Karen's got
There you
it.
go. I'll stop investing for my little one for sure. You're on your own, kid. If I may, can we change direction to the company itself? So it's uDirectIRA.com. What's the journey look like to build this company? And we get your passion for it, and it's really really interesting and great to kind of absorb that. What's kind of been the driver or the growth or the kind of the story behind that?
Okay, it wasn't easy. I'm just going to say, lots and lots of challenges, like any entrepreneur, right? But it really started off with needing a way to use all my skills in an ethical way to be able to provide for my family. I'm divorced. I have 2 kids, and at the time they were still in grade school and junior high school. And how do I afford all the things that they need? So it was more survival is how I started. And I bootstrapped this. And I remember opening my first account in 2009. I had $50, and I'm like, I'm rich, because there was a great recession, and it was tough. But literally having $0 in my bank account at one point, and I just bootstrapped this. To now we have $1 billion under management. So that's been you can imagine there's been this and that, different trials. One of the things, the trials I'll share with you, is that sometimes fraudsters are after IRA money. What was the famous gangster was asked, why do you rob banks? And he said, because that's where the money is, right? Well, where's the money? It's in retirement accounts. So if fraudsters can get to it, they want to. And so there was a local fraudster, and we had a few accounts involved, and those account holders were coming to me saying, what do I do? What do I do? Well, so I'm on the board of directors for our industry, the Retirement Industry Trust Association, called RITA, and I was at a conference in DC. So I met the head of enforcement for FINRA. FINRA, that's an acronym, and it's the enforcement arm for the Securities Exchange Commission, the SEC. Name's Diane. So I talked to Diane, got this problem, fraudsters. What do I tell people? How do I tell people, what steps can they take to be made whole in this situation and see some justice? So she says, well, have them file a grievance, and here's the link to the form with the California Department of Business Oversight, which is where I live in California. So I did, and then these people who were stolen from were rightly very, very angry, and they thought maybe I was in cahoots with this person, which of course I wasn't. So they turned me into the California Department of Business Oversight, and I got this letter saying that I was acting as a broker-dealer and affecting transactions, which I wasn't. And so I called the gentleman who wrote the letter. His name was Tim. And I said, hey, Tim, I got your letter. I hear what you're saying, but I don't do this. And then he was like treating me like a criminal. And that was weird. And I said, look, I hear what you're saying. I'll fully cooperate. I'm going to retain counsel. We'll get back with you. So long story short, I was able to provide proof that we don't sell assets. We don't take any money for any asset. We don't get a kickback, for example, from any asset that's sold at all. It's just a very solid line between the asset sponsor and uDirect. And then we got audited. So it turned out to be a business audit. It turned into a personal audit. So I got investigated and audited over the course of months. And then after the audit was after all the dust settled on all these things, then I got a call from the receptionist, because I was in an executive suite at the time. She's, hi, Kaaren, the FBI is here for you, and they've got a subpoena. So the poor receptionist thinks I'm being taken away by the FBI or something, that I'm doing something. Of course not. Of course not.
It would have been so great if you had like a rope that hung from your window down right in front of this receptionist window, and you just come shimmying down this thing right about that time.
Yeah, it's weird.
Does anybody else ever think about practical jokes like that besides me? Because I mean, that's brilliant. That was your
I was gonna-
opportunity.
Feels like
It
you
was
have
missed.
brothers, you know.
I was going to say, when you've been through all that, that's when you know you want to be in the business. When you've
Yeah,
had
big time.
the FBI knocking on your door, and
Well, and he was the
amazing.
nicest guy, you know. And so it's like, hey, come on up to the office. He sits down. What do you want to know? And I tell him, and I said, what do you want to know? And he says, well, I need this. And what he did is he subpoenaed me for records. He needed our records to be able to put away the fraudster. So we cooperated, and it just created a really nice relationship with that agency, and that we have to this day, as far as being very observant. If we see anything that looks like fraud, just to, just say, hey, I think this could be fraud. What do you think?
And
So-
ironically, when I reached out to you, one of the things I liked about what your online presence and the social media side was the human aspect of it. That you're not a icky trying to be behind the scenes big corporation of like, we're megacorp, self-directed and blah. And so that's really funny that you said you went through that journey, and then there's that kind of heart story to why you why the company and why kind of you've been so successful. That's really interesting.
Well, and it was like really stressful, but in the end, it turned out to be great, because if anybody had any doubts about what we were doing, it was just like taking a shower. We were clean, completely
Vindicated.
just completely
Yeah.
clean and without any question. So it ended up being an extremely good thing, and that's the only way I could get there, is by going through this, But and do I have a shoe collection to rival Imelda Marcos? No, I don't. I invest.
Not yet. Yeah, investing. And that's kind of the key, right? Is like just figuring out that investment and having a partner to be by your side to keep you on the legal straight and narrow, or at least the legislative straight and narrow to get that done.
And
So
that's why I'm so proud of being a part of RITA, our industry group, because we meet with legislators. We're going to be doing that later this month in like 2-3 weeks in Washington, D.C., meeting with them like on panels and having them talk to us, tell us, what are your views and how can we do our job better, and the enforcement agencies, how can we be more aware of fraud? How can we do a better job for our clients? It's really fun to have this nice cooperative environment.
that's excellent. I really want to be mindful of your time. If you could give us a rundown of how people can start to work with you, get in touch, find out information, that kind of stuff. We'll happily share any links in the show notes also.
The very best way is to go to our website, and that's the letter U, uDirectIRA.com. Email us at info@uDirectIRA.com. We're all over social media, as you mentioned, and very accessible. If you email us, you'll get a response within a couple of hours at the most, because we've got staff to take care of it and help you. And so that's what we're here for.
Amazing. Kaaren, thank you so much for your time today. I've learned, Kyle's learned a ton, right, Kyle?
Yeah, this was
I've learned a ton.
90% new to me, so this was great.
Great meeting you guys. I really appreciate the opportunity. Thank you.
Great, and we'll be back next week.
Thank you for listening to the Investories podcast. We all have a story. What's yours? The Investories podcast.